Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to do kind of a split between Twitter and I'm going to go over some information that I've been following towards the end of the clip. So I'll start with Twitter, work towards some correlations that I'm looking at, kind of show you guys when things speed up, when they slow down with gold and uranium, and the Fed funds rate and the 2-year yield. Again, I'm going to go through here, give you my financial opinions. If you guys need any help with anything, definitely check out finding-value.com. And if you want to follow me on Twitter, you can follow me at finding_finance. There's the website. So this is what I was talking about last week on your show. This is her, and this is bank deposits at commercial banks are seeing their largest declines ever in year-over-year terms. Granted, there's still 17.5 trillion deposits in the system, but the rate of change is significant. Banks have two choices: raise deposit rates, killing margins, or keep bleeding. Look at this. Look at this move here for deposits of all commercial banks. That is just tanking, guys. Holy smokes. Thought that was interesting. We've got evidence continues to build, suggesting a huge move ahead for gold, silver, and associated precious metals miners. So this is GDX versus Dow Jones. We've got this ratio chart putting in a massive bottoming pattern, rounded bottoming. We have a downtrend here, a sideways movement, and then we're starting to get some momentum to the upside, where GDX is starting to put in some work against the Dow Jones. And one thing that I think is happening is the market conditions are changing favorable for gold and GDX and all these things. Think low oil prices, high gold prices, and the margins that expand with it. So I thought that was a really cool chart. Looked pretty good. So here's investment wisdom. Warren Buffett says, keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Here's another one. Howard Marks says, there's a big difference between probability and outcome. Probable things fail to happen, and improbable things happen all the time. That's one of the most important things you can know about investment risk. Now, I thought this chart was pretty awesome. What he did is he grabbed the chart of what's going on today and is comparing it to Germany, the value of one gold mark in paper market. So 18 months since writing this, and we are very much still tracking towards hyperinflation in the West. Look at this move from 1918, 1920, and you can see the moves of how this fractal is. And look at the moves of this fractal moving as well. The fractals are very much the same before we could see a large breakout and a big move to the upside. Is this coming to America? I don't know. But it's drawing a lot of parallels. The fractals are roughly the same. So it is pretty insane to see that. That's what I'll say. Says this is from Joel Greenblatt. Says, unless you buy a stock at the exact bottom, which is next to impossible, you will be down at some point after you make every investment. Your success entirely depends on how dispassionate you are towards short-term stock price fluctuations. Behavior matters. So basically, whenever you're going to enter a stock, you're basically going to be down in it at some point because you're not going to perfectly time the bottom, and especially you're not going to perfectly time the bottom within a few percent. So yeah, there's a lot of the times you'll be down 20, 30%, maybe even more than that, 50, 60%. And the way that you react to it is what matters. If you're in it because you've studied the fundamentals, you can try your best to time the technicals, and sometimes it just doesn't work out in your favors. He also says behavior matters, and it depends on how you handle those fluctuations. Here's URNM. This is from Uselink. He says, as you can see below, every time in the past few years where we have broken the golden dotted trend line, we've had a decent sized run after that breakout. So he's got these dotted trend lines coming down. Are we going to break this to the upside and have a little bit of a run for uranium? We'll find out for URNM. But we're getting close to a break. It says the track record of the best investors in the world In tomorrow's article, we'll show you what the best investors in the world have in their portfolio today. So these are impressive track records. We've got Jim Rogers almost averaging 30% for a little over 10 years. We have Druckenmiller, he's down here, a little over 20% for a little less, 13 years or so. Charles Munger, he's down here. Peter Lynch, about 15%. David Einhorn, 12%. George Soros, Buffett. These guys have been doing it for a long time over here. John Templeton. Some of these guys, I'm reading their quotes to you guys, but there's a lot of really good investors in here with impressive track records. It says our preliminary estimate shows U.S. crude storage to fall below the 5-year average next week. Here it is coming on down. I don't know where the 5-year average is here. Oh, they've got this falling below the 5-year average next week. The 5-year average is this here from, that's 2010 to 20. Okay, so 5-year average is about in the middle of this. We've got gasoline storage is at the lowest level for this time of the year in recent years. This is gasoline storage. Generally, when this goes down, demand is not the problem. Demand's yanking it out of inventories, and it's pulling it. There could obviously be some weakness in refining volumes, but it's real low for gasoline storage. It says, what I learned from the best investor in the world, Charlie Munger, about his first 100,000. He says the first 100,000 is a bitch. The first 100,000 is a bitch, but you got to do it. I don't care what you have to do. If it means walking everywhere, not eating anything that wasn't purchased with a coupon, find a way to get your hand on 100 grand. After that, you can ease of the game a little bit. And that's trying to get your first 100 grand, basically get the investment going. We've got platinum here. Platinum setting up for a major impulse move higher. We've got the long, consolidation from 2008-ish all the way down to the bottom of 2020. We've broken out. We've done an inverted shoulder, head, shoulder, perhaps, and a potential move on up. Gold, platinum. We've got gold's long-term target to $3,000 mark within 12 to 18 months. We've got a nice little breakout here if you go off the closing prices of these. And we could be going higher at any time soon with this nice cup and handle pattern. Cuppy says, I like big draws and I cannot lie. Weekly oil and products inventory report. Crude down 7.5 million. Cushing down 1.6. Gasoline down 2.9. Pretty big drawdowns there. Now, also, what I want to share is I've got some data here. This data is Camco. And what I want to show you is the Fed funds rate, the 2-year yield, and gold. And kind of draw some parallels between the last bull market back here from 1999 all the way up till 2007-8. And what we saw is a couple of cycles here. We can also throw in a cool little chart where we broke out on the Fed funds rate moving higher there. I had to do that, guys. Sorry. Just had to. When we were in the beginning of this cycle here, we saw an increase from 1998 all the way 99 into 2000 where the Fed funds rate was increasing and it paused. We saw uranium basically kind of eat it in the beginning of that pause cycle. And then we started to wake up during this first kind of move. They yanked down the Fed funds rate and uranium. Let's see if we can kind of zoom in on this. Uranium pulled back. This is CCJ. I'm just using CCJ. So you can see that we pulled on back and we pulled back in CCJ. So we have the Fed funds rate come up and it paused and then it went back down and then we were coming up and then that recession did have an impact on it. Are we at that point where we could pull back or are we going to run first? Difficult to say. Looking, going forward, we'll do that here shortly. We can also see the 2-year yield fell before the Fed funds rate fell. So our leading indicator was this. The 2-year fell before the Fed funds rate. and the Fed funds rate was lagged behind it. So the 2-year is our leading indicator. Gold didn't really take off. It was kind of still meandering lower here. And it came on down here. It came on down, and gold basically got kicked off. We had the peak in the 2-year yield coming back down. We had the Fed funds rate come back down. And then gold just kind of took off and never looked back. So if we zoom out here, gold had a very nice run. This was the beginning of this bull market here. It's right here at the beginning. We did the accumulation period, and then we launched. The Fed funds rate went down during this bottom of this accumulation period. Then we launched everything up with it. You can see that uranium kind of took off before the Fed funds rate bottomed. We also saw the 2-year yield bottom here and then started to come back up. Very similar to what uranium has done. So that bottomed, came back up, bottomed, came back up. Now, when we look at today's markets, and I'd say 2020 is kind of the bottom here, and you could almost say that 2016 might have been. 2016, we were increasing interest rates, and then we had a problem in the system, definitely launched to the downside. We could see that in 2018, October, we could see a problem in the system as well. The 2-year yield started to fall. And that's where our buy points are generally where this thing kind of bottoms out in a row here. If we were to look at the last bull market, just to kind of go back and see where this thing bottoms out, we have, let's do a vertical line right on the bottom here. That's real close to where this thing, it's basically coming down, and it almost bottoms out rates before your CCJ bottom right before rates bottom. For a good, I'm trying to get the timing of when this stuff kind of happens. Obviously, we're just playing with data here. So in the beginning of the last bull market, we had a buy signal in 1998-99 with the commodity to stock ratio. Uranium still fell a little bit. It went into an accumulation cylinder from 2000 all the way to the bottom of 02. So it came up and then came back down. And this was a recession here. The 2-year yield fell for a little while before CCJ. It started falling before uranium or CCJ began falling. So when we look forward here, we've got the Fed funds rate that's still increasing, and maybe it's going to go sideways, but we have a little bit of a scare in the 2-year yield here. And that's where it's like, what's going on here? Could we get a downward move in the 2-year yield? And how fast could this move as well? Is there a problem in the system? We've got the same accumulation, I think, cylinder. And again, maybe the pullback comes back like that before heading higher. I don't know the future. But if it were to do it like the last bull market, we would see this kind of pause and then come back down, or maybe it's going to come back down immediately. I don't know. I know that this is one of the fastest rate hike cycles, so maybe it's going to return or reverse quite quickly. So that is something that I'm watching, is how fast is this thing going to come back down, and what's the 2-year yield going to do? Is the 2-year yield going to fall down here? If it starts to fall down, that's generally a leading indicator before the Fed basically turns of what could potentially be coming. And usually when that 2-year yield falls, something is wrong in the system. So that's what I'm watching for. I've noticed that gold is about to take a run. If we put gold in here as well, we can see gold. Once this kind of bottomed out, gold just took off. Now, gold did very well from the beginning of the commodity to stock ratio. It did very well the entire way. It was a pretty consistent run during that entire time frame. And it also ran on the back side. Even when they did all that reflation, it still ran and accounted for that money till the eventual peak. But commodities were basically done at that point. Looking at where we are today, it looks like to me that we are about to start running in gold here any second. So maybe this here is just an early move where we could see one last kind of drawdown in a wave 2, which is possible, like if it were to happen like the last bull market, we get one last kind of flush out before a move higher. And again, I don't know if that's going to be the case. Maybe we just rocket higher and we move on to the upside. I'm not going to be selling my shares. I'm just going to hold on and ride this beast. But it'd be nice to get more shares at very low prices if this were to get one last puking situation. That situation here, if you were to look, there's Camco. Let's get rid of some of this down here. I'm just going to do a quick how big this drawdown was. So this drawdown here was about 40-something percent, 46% from peak to bottom. And if we look at the current drawdown that we've got today, the current drawdown that we have today is roughly, we went down about 35% to the bottom here. Are we going to go back down? And 46%, if we were to 40-something percent, maybe $17, $18 if it were to repeat that. So that is a possibility. Not saying that it's a likelihood. I'm just saying it's possible if it were to repeat like the last bull market for CCJ. And that's kind of what is potentially out there. So that's what I've got for today, guys. I'm going to end it there. Hopefully you like the content. Give me a thumbs up. Subscribe to the channel if you haven't already. And we'll catch you next time. This is Finding Value.